Okay. I think we'll start now. Welcome everybody to Reading the Tea Leaves with the Westchester Community Foundation. I am Laura Rossi. I am the Executive Director of the Foundation. I am joined by Laura Saunders from the Wall Street Journal and Jose Reynoso from Clarfeld Citizens Private Wealth. For those who don't know, the Westchester Community Foundation is a philanthropic charitable organization. We are a 501c3. We exist to improve the quality of life in Westchester County. We were established in 1975 as a division of the New York Community Trust, New York City's Community Foundation, which was established in 1924 and holds $3 billion in charitable assets to improve the quality of life in New York City, Westchester, and Long Island. We hold permanent endowment, but we also are a sponsor of donor advised funds, which are an easy, tax-efficient vehicle for charitable giving. And therefore, taxes and avoidance of taxes and the charitable deduction are of great interest to those of us in philanthropy in the nonprofit sector. We work very closely with professional advisors such as Jose, who work alongside their clients and their families to give now, and also in their estate planning for legacy purposes for the causes and issues that they care about. So the space that we're in is helping folks align their financial life with their values to make a difference in our community and in society. Some folks are having a little trouble logging in, so I'm not quite sure. We're just going to keep going. The current administration is focused on transformational change and reshaping government's role as to our economy and day-to-day opportunities for people. And therefore, tax law and policy is very much in the news. To recap, in March, President Biden signed into law the American Rescue Plan, which provided cash payments to individuals and included a number of individual tax law changes that benefited low-income individuals. Increases to child tax credit, the child independent care tax credit, the earned income credit, and some premium reductions for the Affordable Care Act. And I'm recapping that because some of these changes seem to be moving through ongoing discussions and broader tax policy changes. There are currently two plans in discussion. The American Families Plan, which would increase taxes on wealthy individuals through higher capital gains, increases to the individual income tax rate, the elimination of the step-up in basis, and other measures. And then the American Jobs Plan, which would increase income taxes on corporate profits and is proposed to help fund infrastructure improvement. So today's conversation is on the American Families Plan, which is how the Biden administration is proposing to pay for certain social programs, such as free kindergarten, community college, assistance to other colleges and universities serving minority groups, paid family and medical leave, nutrition programs, childcare, and other provisions in the Affordable Care Act. And these are big changes, and they're of interest to us as a community foundation. We see a lot of need in all those areas, and philanthropy works to address a lot of those needs. So there's a bigger conversation around who pays for this and how is this paid for, and how that takes shape in tax law and policy. These are shifting sands indeed. So we have some experts to explain all this to us, sort of what could be happening, what do we see? Laura Saunders, thank you for joining us. She's an esteemed reporter with the Wall Street Journal, specialized in writing about taxes, first at Forbes, and you've been with the Journal since 2009. Taxes sit squarely at the intersection of economics and politics with consequences for all of us. She also has a passion for literature, has published essays on Ralph Ellison and Flannery O'Connor, Herman Melville. She holds a bachelor's from Sewanee, the University of the South, and a master's from Columbia. And she's won 4 awards for her writing from Financial Planner Associations, CPAs, and journalists. And the reason she has done that, won these awards, and the reason I enjoy reading you, Laura, is because you take these really complicated topics and you make them understandable. And
We
that's
try.
important because taxes and the public fisc are an expression of our values and what's important to us in society. And that's what you bring into your writing. So I'm thrilled to welcome you.
Thank you. Thank you.
Thank you. Jose Reynoso has served on the Community Foundations Board for 9 years and cares deeply about issues in our community and needs. He came to us through the Apoyo Fund around Latino organizations and strengthening those. That goes back a long time. He's a member of our Professional Advisory Council and has previously served as president of the Estate Planning Council of Westchester. And at Clarfeld Citizens Private Wealth, he leads personal financial planning, advanced tax and estate planning, and trust services. He's an expert on income, gift, and estate planning and has led panel discussions on tax developments, complex giving strategies, philanthropic planning, and family governance. You have a bachelor's from Cornell, and you currently serve as treasurer of Cornell's Latino Alumni Association. Jose also holds a JD and an LL.M specializing in taxation from New York University School of Law. So you're both New Yorkers, which is wonderful for us. And we're hoping to have a little time on New York State tax law from Jose as well, if we have some time. So you are here to help us read the tea leaves as to what is going on in terms of the conversation. Let me just take a pause because I just want to see folks need to, I'm not sure how to tell that. Tell folks that if they can't log on, go to their Zoom account and then go to the link for the webinar. Okay, so here's our format. This is really designed to be an interactive discussion between Jose and Laura, and you all as participants. You are welcome to put your questions in the Q&A box, which I will monitor, and we'll weave those questions into the conversation as we sort of see where the conversation goes. There's a lot of moving parts to tax law and a lot of speculation, I would say, that I've been reading is sort of what the current conversations might mean for law and policy. I'm curious as to your senses, both of you, of the timeline of all of this, and what the bargaining and the trading could be. So we'll start with from you, Jose, with a bit on sort of broader picture, but specifically the topics we do want to cover for this webinar are the capital gains, estate tax, but particularly the step up in basis. Laura, you wrote an article at the end of April, which got 289 comments. Death and taxes, lots of questions, gifts to grandchildren, gifts to charity, how all this could affect. We want to talk a little bit about retroactivity, what the thinking might be, because that will definitely affect planning. And then hopefully a little bit on New York State, because that can also impact somebody's total tax landscape. So I'm going to hand it over to you, Jose. Tell us what you're thinking and what you're seeing for these conversations on the Hill.
Thank you, Laura. Thank you for the time. Happy to be here. I thought, Laura and I thought we'd start by I'd list out the tax proposals that are part of the American Families Plan briefly, and then we'll take a little dive into the relevant portions that Laura Rossi identified. Number one, the top individual tax rate increased to 39.6. That is the proposal, 39.6%. The one that everyone's talking about and that is on everyone's lips is the increase in capital gains for high earners of income over $1 million to equal the top tax rate. That's 39.6. That's a big one, right? From 20% today to potentially 39.6 for earners of over $1 million. Third,
let me jump in there. It's not
Sure.
only 39.6, but if you're at that level, you're going to have an extra 3.8 in the net investment income tax. So the top rate would be 43.4.
Absolutely. Absolutely.
And that's without state taxes. That's just federal.
Yes, indeed. So ending step up in basis, as Laura Rossi mentioned, we'll talk about that a little more. And the Green Book issued in May, all 114 pages, does devote rather significant time on the rules around this. So we'll get into that a little bit. Ending the lower rate for carried interest, ending 1031 like-kind exchange for gains greater than 500,000. For those in the real estate business, you know that 1031 allows deferral of gains for property, real estate specifically only after 2017, using a trade or business or for investment purposes. And applying that net investment income tax that the law Saunders identified to incomes over 400,000. That's actually a big one that hasn't been talked about too much, but could be incredibly impactful. Making permanent certain changes to 461, that's using crossover of excess business income losses over to the personal side, so disallowing them permanently. And then just to increase, significant increase in funding for the IRS, right, for tax enforcement. So that's the list, and that's the list that Laura Saunders and I will work off of, focusing on that dreaded 39.6 that absolutely would add the 3.8 NII tax and the step up. Any comments on anything else, Laura, that I may have missed?
Well, no, you really hit the highlights. I would just say that since we're talking to people who are, we're talking from a charitable point of view, that the administration has been pretty careful to make sure that charitable contributions still have the favored treatment that they have had. They're deductible. And also, if you make a contribution of appreciated property, that is to say you bought a stock and it went way up, if you give that asset to charity, you get a full deduction for the market value without owing capital gains tax. That is still in the code. They haven't done anything about that. And to the extent that tax rates rise, that actually could make the deduction somewhat more valuable. Although you don't mint money by making contributions, you must have charitable intent. So I think I wanted to get that front and center. That's the other thing is that, you know, the bill that we got in March, I guess it was, is allowing $300 of charitable contribution deduction per item, per person for people who do not itemize this year.
Right.
Last year it was $300 per tax return. The charities have really wanted this because they didn't want it to be confined. They wanted something, a charitable benefit for people who don't itemize, since so few people are itemizing now on Schedule A. So those are the two kind of charitable highlights. The deductions remain, and this year there's a $300 per person deduction if you don't itemize.
Yeah, and I would add that the continuation of the 100% of AGI deduction that's available. So the CARES Act extended, so contributions to charity are generally determined by the type of charity you contribute to and the type of asset that you contribute. So public charities, like donor advised funds, actually generally get up to they used to be called 50% deduction charities, but actually the 2017 Act increased it to 60% if you contribute cash, right? Interestingly enough, the CARES Act increased it to 100%, but unfortunately not to donor advised funds. So you can contribute 100% to public charities other than donor advised fund, unfortunately.
But let's be clear. Let's just be clear about this, which is that that usually you get the whole deduction. It's just how fast you get it. You know, when you talk about 50% or 100%, it's tied to your adjusted gross income. And so what that really means is that if you go outside that limit, you still get it, but you get it the next year or
carry
within
forward.
5 years or something like that. It's
5 years. Yep.
So when you're talking 50, that doesn't mean you get half your deduction. It just means you might have to stretch some of it out if your contribution is very large relative to your income.
Absolutely.
And I just
Absolutely.
wanted to make a point, because you're right, there are, donor advised funds are a vehicle for charitable giving, and there are some restrictions on how you can use them. For instance, IRA, the minimum. But at community foundations, such as the Westchester Community Foundation, we hold a number of funds. And there are other funds where folks
Good
can
point.
we are a 501c3. So I just couldn't let that pass, Jose, without mentioning
I'm
that.
sorry about that. That's the next point I
Because
needed to
a lot
make.
of folks, sort of like, well, what do I do? What if I don't know what to do? Or how about I trust the community foundation, which knows how to, meet current needs. But I'm pleased, Laura, that you mentioned that, the current plan is holding steady on charitable deductions. But I'm concerned about, where you see folks will modify their financial planning given this rise in capital gains. And also, as we move into the next segment, the estate tax and
Yeah.
step up in basis and sort of longer term planning. Because, folks who maybe aren't charitably inclined, what happens there as they look at the whole picture?
Yeah. Well, I wanted to make sure to mention one thing as we talk about this, just to table set a little bit. The capital gains, one thing that the Green Book made clear, at least aspirationally, because the Green Book it's the sort of opening salvo. It's not the final determination of law, but it's certainly what is used to develop a revenue score by Treasury. The capital gains would be set to be effective as of date of announcement, the
Yes.
capital gains increase. Date of announcement was April of 2021. So all these other changes that I listed are 2022 items. The cap gains would be this year. So that's important for all the listeners who this has been highly reported, certainly. But that's a recent sort of newsworthy item that the Green Book sort of spotlighted really.
Yes.
And so that's an interesting point.
Yeah, and let's be a little clear about this. It was the end of April, so it's for transactions, that is sales after April, probably 28th, although they didn't specify that. That was date of announcement. Now, the frustrating thing here is that could change going forward. I have seen this happen. They don't want to roil the markets. They don't want to say this is effective January 1 next year, because then that'll affect all kind of trading between now and then. So they usually put it in at the date of announcement. Then sometimes as things are negotiated forward, they will move it forward, date of the committee acts, date of enactment, date of signing, whatever, things like that. And so we cannot be certain that it will be the end, that the starting point is the end of April. That is a threat right now.
Yeah, definitely. I think I couldn't stress that enough. This is the starting point for negotiations. It was chosen to develop a revenue score by the administration, by Treasury. And just to be clear, what the Green Book does say is effective for gains required to be recognized after that date. Gains that would be required to be recognized after the date are gains all throughout 2021. So,
Yes.
so it would be pretty onerous. But I think Laura Saunders is absolutely right. It's an opening bid. Let's see what happens. I think Biden and the Senate through Senator Capito are worried on the infrastructure plan right now. So they're really focused on the corporate tax changes potentially under the Made in America tax plan. So we'll see what happens as they get to American Families Plan, which is going to take some time.
And remember that yesterday, I think we reported that Biden has signaled that he's willing to compromise on corporate taxes and maybe not raise them as much as he thought. So it just shows that everything is in play. But these are things to pay attention to.
Great point.
Can I ask Laura a follow-up in terms of, keeping an eye on the markets, right? Because last year was really a tough one with where the markets are. There's a lot of uncertainty in terms of economic recovery, et cetera. What is your sense of timing for, they're working on the one plan now, and then this is sequenced, right? So then they're going to work on the next plan. There's a lot of folks positing that, you know, they're coming, yeah, they're going to start with the high net worth folks, but they're coming for you, middle class. You know, there's a lot of agitation, it seems. What is your sense of that kind of conversation in the air and the sequencing of this legislation?
These are obviously questions I ask every week, you know, my sources and things like that. And we never know, you know, a fool's errand is trying to predict the course of legislation. We can say that if things don't get done somehow fairly soon this year, or maybe early next year, you're in an election year, and that kind of stops the process. Also, these proposals are facing enormous headwinds, huge opposition. I got a letter from the National Federation of Independent Businesses the other day. They're a very strong lobby, you know, with 1,000, they signed up 1,000 people to protest, you know, business owners to protest this, small business owners, because you see, one of the problems with this plan is that it doesn't affect only very, very wealthy people. It also affects people in sort of the upper middle class or even middle class whose income spikes in that direction. I heard from a man today who was selling 2 gas stations and maybe a convenience store, and he's working his whole life. If that comes to more than $1 million, he would owe tax on the amount over $1 million in the plan. So there is a lot of people are highly skeptical. As Jose said, this is an opening bid.
Right.
But it bears watching.
So we have a couple of questions from the audience, if I may. And one is, to what extent is the $400,000 threshold on taxing the rich still in play? This is an assault on the coast middle classes. How can people earning just over $400,000 be compared with billionaires for tax purposes? I've seen a lot of that kind of conversations in comments, especially when you get into couples, right? And places like New York and Westchester, which is a high cost of living, you know, is this still in play, or do you think for political reasons this might start to go by the wayside? What do you think?
I mean, okay. Good, Laura, you can, I could just quickly tell you what I read and what I read in the Green Book, and it's not as much in play. I think, you know, that which would have impacted those over 400,000 would be, you know, capping the value of itemized deductions to 28%, which would have been, those are generally the P's limitations, which would have impacted the 400,000. Imposing FICA tax on income for over 400,000, that's not in the Green Book either. So my assessment is that generally it's been put aside, although the NII at 3.8% is still in play for those over 400,000. So I think it's generally been put aside from what I'm seeing, at least in the Green Book, and that's from the Treasury, Biden administration. But what do you see, Laura?
Well, I would say that the 2 places that the administration is extremely vulnerable on the $400,000 promise, and they have, I don't think they backed off from it really. The promise is nobody who earns $400,000 a year or less will pay more taxes. And there are 2 places they're vulnerable. One is with retirees who have maybe $3 or $4 million, but their income is $250,000 or $200,000. That could well be in a place like Westchester County. Now, those people, because of the step up and other things, could pay more either during life or at death. Also, people who have spikes of income because of a one-time windfall. So I think that they're vulnerable that way. And they haven't made an estate tax proposal yet. There's a campaign promise, which I don't think will ever happen, but to bring the exemption down from 11 million to 3.5 million. But again, if they did do that, that will affect a lot of people who have income less than $400,000. So those are 2 places to watch. And that is being discussed in Washington right now, you know, because I think everybody remembers when George Bush the elder said, "Read my lips, no new taxes," and then he did not win a second term. And that is burned into the politicians' memories. So that's kind of underneath all this, right? Don't you think?
Yeah, no, that makes a lot of sense. That's true.
Um,
Oddly enough, Reagan, after he reduced taxes, proceeded to increase taxes 4 times, and it didn't hurt him. But yeah, that Bush comment crushed him.
exactly.
So this is a good segue into death and taxes and estate planning. Let's talk a little bit about the step up in basis, which, has a lot of conversation going on. What do you think, reading the tea leaves? Apparently it's been talked about for years, but this seems to be a fresh look given the past year and a half. What say you on the step up? And I know you've both been watching it very closely. So what should our audience know?
Well, I guess I'll just start with what you see in the Green Book, right? So number one, the estate. So there's no mention of the estate tax exemption going down or the rates changing, right? So just to make that clear, the exemption is very generous right now, 11.4 million, 7 million actually, I think, and times 2 if you're married, and it's portable, and the tax rate is going to remain the same. So there's no mention of the change, but what could be even more hurtful to more people is the elimination of the step up. And I'll just kind of set it up, and I'll have Laura comment on it. So presently, a decedent, and the Green Book actually expands it, but I'll just tell you what the current law is. Presently, someone who passes away, their assets that have had appreciation in them, that appreciation goes away. To put it simply, right, the recipients of those assets, that Apple stock that cousin Susie receives, you bought it at $10, it's now $100,000. It's that endless gain is gone, and Susie's basis is 100,000. She could sell it for 100,000 and pay 0 taxes. So it's a pretty generous system as it exists now, with the idea that you would have paid taxes during your life, and the recipients of appreciated property don't pay tax. So what does the Green Book say, which is an extension of what Biden's been saying, is that that would go away. So essentially death or the transfer would be a recognition event. So now there'd be tax to pay, potentially at 39.6% for those with earnings over $1 million. So pretty scary. But I just want to add one final thing on that. What the Green Book actually makes clear in terms of an expansion is that it's not just at death. There's certain transfers in life that would be triggered as a recognition event. So this idea of taxing capital gains on transfers could be extended during life, not just at death, according to the Green Book. Again, opening salvo, opening bid, we'll see what ends up happening.
Yeah, I have a lot to say about this. It is important. First thing is that there is an exemption, and each person would get $1 million of step up. That is to say, appreciation, tax exempt appreciation on assets, plus $250,000 on a home. And so that still will cover a lot of people in the United States. It won't cover as many people in New York City, Westchester County, or San Francisco as it does in Omaha or Abilene or something like that. And particularly I want to call attention to something that affects Westchester County. Currently, if a couple owns a house jointly, and there's some very nice real estate in Westchester, and one partner dies, then if that partner's half of the house gets written up to market value with no tax. And so if the survivor sells the house, there's a lot less tax to pay than there would have been if they sold it as a couple while alive. Now, these proposals will mess that up. because you would basically be getting $250,000 per person tax-free of appreciation on real estate. And so then if your house had appreciated, you bought it in 1975 and there's $1.5 million of gain and one partner dies, then you'd get free $250,000. And then above that, you could use some of your $1 million exemption to cover that. But if you have other assets, it wouldn't be available for them. Am I making myself clear here? So that it's something that homeowners need to think about, particularly older ones.
So what does the recently widowed homeowner in Westchester, say, do if she's got more widower holdings? You know, her stock has gone up, right? The market's gone up. Her house has appreciated in an incredibly high market. She or he wants to downsize. Do they have to move to Florida? Jose and I have talked about, you know, what do they do at this point?
Well, at this point, maybe they go on and sell and hope the law won't change, and then they'll be in, you know, better shape, or they watch the law very closely. If it changes the way that Biden wants it to change, then there could be a good bit more tax to pay and less shelter provided by the first death.
Yeah, and I think what
right.
Absolutely, and I would add that you then start looking at more smoothing and deferral strategies, right? Generally speaking. So I think not just in the example that
so
you
I think
mentioned,
what you're saying there is that, okay, you're holding Apple stock and it's got a huge appreciation and you know it's going to get some tax at death, but you don't have that much income now. You know, maybe you have under $500,000 of income. So maybe you start taking some of that, like put yourself on a capital gains diet, as it were, and taking some of that year by year. There's another way to look at it. I mean, that's one excellent strategy. The other thing that financial planners might say is, look, tax rates change every few years. If you can wait, you may be better off, but you need to know you could wait 3 years or 5 years or 10 years. So
absolutely. And the individual circumstances will definitely determine that. I mean, there are things like using charitable remainder trusts.
Yeah.
You know, you could contribute to a CRT and the gain, highly appreciated asset, that gain would not, you sell it inside of the CRT and there's no gain to you immediately. What people don't realize is that a CRT is actually more of a deferral mechanism. So it really fits under the deferral and smoothing sort of broad category, because ultimately there are ordering rules and the annuity back to the donor would actually contain some of that cap gains, because that's how it works. But absolutely, I think it depends. I mean, you're right. I think as planners, and I'm one of them, you know, orthodox thinking is you don't accelerate taxation, right? Deferral is good, right? Deferral. You don't know what's going to happen. But certainly the facts will dictate. And I think that you're going to have those conversations, things like installment sales strategies, other strategies.
And this is a really,
what about gifts to
well,
children?
wait, can we stay on this for 1 second? Yeah. I just want to say that a lot of planners are, for this reason, recommending Roth IRA conversions. And that's a whole separate complicated story. But if the law passes the way Biden wants it, and if the law on Roth IRAs doesn't change, 2 ifs, then Roth IRAs would be the last asset standing where appreciation at death is not taxed. Correct. And so,
yeah, and if in a rising rising tax rate environment, the Roth break-even analysis becomes much more attractive, for sure.
Yeah. So, and I plan to write about what?
I was asking Jose to just unpack a little the Roth break-even analysis for.
Right. So a Roth conversion involves taking otherwise a traditional IRA with significant embedded gains, really ordinary gains that haven't been taxed. You know, those before pre-tax contributions, You have a $100,000 IRA, perhaps it's entirely taxable. You can take that entire $100,000 IRA and convert it to a Roth. That's a taxable event. That $100,000, at least in my example. In many examples, there's some after-tax money in there that wouldn't be taxed and it wouldn't be rolled over. Rarely, right? So let's say it's $100,000. That conversion is a taxable event. It's all ordinary income tax, right? However, the strategy is to use other assets, not the IRA assets, to pay the tax, right? So you don't want to diminish and decrease the now Roth 100,000 because you want part of the break even is to have that Roth grow fast enough, right? On a no tax basis, right? And still be able to use, because remember, Roth, you can take distributions from a Roth tax free, right? And there are no minimum required distributions. So it can actually stay together for a long time. So the break even analysis is I have to pay the entry fee, the tax on the conversion, but how do I get my Roth to accelerate, to grow fast enough to then make me break even? I make up for the money I paid for the taxes. So the way the math works, right? If taxes are going to increase over time, then you're better off converting, because in theory, if you go side by side of what would have happened if you didn't do it, if you simply took out money from the taxable IRA and paid at a higher rate, you would have less. So the way we set up these break-even analysis is you go side by side. You keep a traditional IRA and you take distributions because you have required minimum distributions at a high tax rate, or you don't. You pay the entry fee and you let it grow. And especially for those that are a bit younger and they can keep it longer, or forget about age, who think about using the Roth as an estate transfer vehicle, then the conversion starts to make a lot of sense, because the longer time you have, the more you make up the money that you lost, and you catch up on what you would have earned otherwise. I'm sorry.
And could I say a couple of things? One is that, New York has an estate tax. And so that can help shrink your estate for New York's tax purposes. The other thing is that this analysis is all very good as long as Congress doesn't change the law on Roth IRAs, which they actually have done a little bit in the last couple of years. Watch this space, I plan to talk about the political threats for Roth IRAs. I don't think they're very high, but they could exist for people with very large ones at the edges. And so, I'll be into that.
We'll be watching.
With anything else, though, I just want to say for those listening, a Roth, you need to do the analysis for yourself, right? I don't think Laura and I are blanket saying you should go out and convert your traditional IRA. But it absolutely deserves a look, especially in these times of increasing income tax rates.
And Laura was signaling that the Biden administration plan is sort of, encouraging us to look at Roth IRAs, or at least reading the tea leaves. That's what it seems. We have just a few minutes left, and I wondered, Jose, in terms of New York State taxes and New York State estate taxes, and Laura as well, as we're looking at what's happening on the Hill, those of us in New York also have to think about our state tax burden. What do you see from Albany? I mean, what did we think would happen that didn't? What might still happen? What are the politics around this? Can you speak to that a little bit?
Sure. So April 19th, 2021, the budget bill passed. Right. Governor Cuomo signed it that day, actually, more specifically. So it did a few things. New York did indeed raise personal income tax rates fairly significantly for the high earners, for the mega earners, frankly. And I'll go through it. I'll just list them out if you'd like. But it didn't do a few other things. So let me just tell you what happened specifically in the state personal income tax rate increases. What are they, right? So the increases. So the top rate, the top rate used to be 8.82%, and now the new rates range from 9.65 to 10.9%, right? 9.65% starts at income over 2.1 million for married filing joint. So at fairly lofty levels. But in New York, it actually probably will apply to significant numbers of people. So 9.65% for income over 2.155 for married, and for single, 1,077,000, right? So roughly half, not quite. And that's for up to $5 million. And then a new rate of, so that's 9.65. Starting at 2 million, roughly 2.1 for married, 1 million for a single, 10.3 million starts at 5 million, 10.3%, sorry. 10.3% starts at 5 million up to 25 million, and then 10.9% for 25 million and up. And that's temporary. These new tax increases for these lofty earners is from this tax year, 2021, to be clear, it's effective immediately, through 2027. So it's temporary. So significant increases at the very top of the rate scale. And as we know, right, we're talking about Westchester County, but we know that in New York City, the New York City top tax rate is 3.876%. So it's pretty high for those living in New York City, right?
Why this year? I mean, was it political for this jump? Because it's been talked about for a long time, raising the income tax rate on high earners. And then there's always the pushback, no, everybody will leave, people will go to, less tax states. In your estimation, why did this?
Some have, the billionaires, several.
Yeah, we're going to lose.
Yeah.
Why this year?
I think the rhetoric, budget shortfalls, right? Significant budget shortfalls projected although with the Biden COVID relief bill, there's a lot of money coming to New York. So maybe that's probably not as a valid an argument, but it's to fund initiatives. The unemployment rate for New York is probably double the national rate still, certainly New York City, interestingly enough, right? Because New York usually is lower because of the shutdown and businesses starting to ramp up. I mean, we've got a new labor print today, which is really positive with the jobs at $559,000, 559 nationally. But yeah, I mean, I think that was the rhetoric. I don't know, Laura, if you had heard other things, and then I'll touch on what wasn't addressed in New York.
No, I yield to you.
Okay. There were other changes, but I'm not going to go through material parts of those, mostly on the corporate side, right? And addressing SALT to a degree through pass-through entities, but it's fairly complicated and doesn't apply to most people, but it is out there. Happy to follow up for those who are interested in it. So what did New York not do, right? So it absolutely increased the taxes on the mega earners, right? That's what it absolutely did. It did not touch capital gains taxes specifically, right? No specific increase in any way, material way, or delineation or separation. But also no middle class tax cuts. And there was a lot of political rhetoric about cutting the taxes on the middle class. That wasn't that didn't get addressed. There were no increases in the estate taxes either. So we talked about federally, the exemption remains the same. New York, there were competing proposals, a few of them, to increase estate taxes in New York. It was not increased. This budget did not increase estate taxes, and a number of different things, but those are the big ones that were not addressed. So higher rates.
I would just say that New York is under such pressure not to increase its estate taxes. New Jersey got rid of theirs. I mean, when I first started covering state estate taxes years ago, I think 30 states had them, and we're down to 9 or 11 or something now. They're not the tax of the future, I think.
I think that's right.
States would rather tax the income of the high earners every year than get an estate tax at death.
Yeah.
Well, I have a couple of questions in our last couple of minutes, Jose. Were there other things that didn't pass that we should be aware of because they might come back to bite us on the New York State piece?
Things that didn't pass that might come back to bite us. Let me take a look at my notes. Other than what I mentioned, right?
Okay.
So, I mean, things that, nothing that I think broadly,
Okay,
well, there are certain pied-à-terre provisions which could hurt those that are not living in New York, but have a pied-à-terre, meaning like a home, a place of abode.
so I do
Those,
have a question from somebody saying my primary residence is not in New York. Of the topics, donor, but primary residence not in New York. Of the topics you discussed, which are universal to non-New York based people? That's a question. And another question, just from final, is bottom line on the 400,000 threshold, will it pass in your opinion? Back to the federal conversation. I just want to get those two questions in, non-New Yorkers and the 400,000 threshold. What do you guys think?
one thing, non-New Yorkers, be careful, right? I mean, there's statutory residency in New York, depending,
Oh, those
right? If you,
it's so complicated,
eh,
and and so easy to fall into it.
yeah,
Yeah.
if 183 days plus a place of abode, it's a defined term, even if it's not your primary residence, can kind of pull you back into New York. So be careful. If you work in New York, you already know how you're being taxed and pulled into the New York tax nexus. So besides that, if you can clearly be non-New York, yeah, then you probably are okay. But remember that even though if you have a place in New York, if you sell it, you will have New York cap gains. You will have New York tax, I should say, period, in a general way, because you can't escape that. It's New York real estate. It will be taxed by New York. That's New York source income. So I think besides that, I think just be careful falling into the trap of being, the states have gotten very aggressive, northeastern states, particularly all of them, northeastern states, you name them, in taxing those attempting to avoid taxation in whether it's New Jersey, New York, Connecticut, Massachusetts, you name it. But generally, just be careful. And if you're truly not New York, you probably shouldn't worry about it other than the property that you own. And what was the second question?
400,000.
Yeah, the bottom line on the 400,000 threshold. In your opinion, do you think it will pass?
They didn't. It's not in the green. It's not generally not in the green book. Other than the one that would have hurt quite a bit is FICA, taxing FICA over 400,000. I think I haven't. I don't know if I mentioned that, but
And that didn't happen. Yeah.
it didn't happen. I mean, FICA, is limited to $165,000 is the cap, right?
Well, it goes up every year.
Right, goes up every year. It's 6.2%. I mean, at least the Social Security part, and FICA is 7.65 for those who work for a company or not self-employed. That 6.2 would have come back at 400,000. That would have been pretty onerous. It's not mentioned. So the answer to the question is, it's not in the green book. It's not in their opening sort of bid. I think that's going to be culled, not expanded. I don't know if Laura, you agree?
Well, it's funny about that. It's interesting that it was not in the book. Sometimes they hold these things back and spring them at the last minute, but that can happen. I've seen it happen, but sometimes they just fall away. If they weren't in the first version, they're not in any later version. We don't really know. I just, stay tuned, I guess.
Yeah. Although, I mean,
I do think that Biden needs to take that $400,000 promise seriously, because he will get a lot of blowback. And I think that politically they're aware of that. We'll see what happens.
So for the audience, I mean, we didn't get into retroactivity, but maybe that's okay.
Well, the only point that's so far, just to make sure, that cap gains is sort of retroactive, right? I mean, as of date of announcement,
Yeah,
that's on the table. We'll see what happens.
Yeah, to April 28th, right?
well, late April, which we think is late April 28th.
Late April. Okay.
But
Any final points other than be sure your financial planner is following these topics closely, and we don't know when the legislation, what the horse trading will be. We really can't tell from the current horse trading what will happen, right, Laura? Go ahead.
Yeah, I have a story published today on the $250,000, $500,000 exemption on selling your home. For a lot of people, that's the biggest single tax exemption they'll ever have. You can use it every 2 years. You don't want to get it wrong or mess it up. It's a good time to get good tax advice. It's a hot seller's market. And so if you're thinking about selling, go talk to somebody before you do it to see
Right.
where you'll be.
Right, good. Jose, any final piece of advice for our audience?
I think some people have been advising wait and see. I think that's a dangerous thing to do. I think you need to be actively, just as you suggested, Laura, actively looking at what's going on, actively thinking about your personal situation. Because obviously you don't want to let the tax tail wag the dog. Nonetheless, that tail can have a big impact on the movement of the dog. So I think you want to take a look at your personal circumstances. What's happening in your life? What are you trying to accomplish? Generally, we believe tax rates are going to go up, certainly in the short term. And if there are things you want to accomplish in the short term, then you really want to understand how to maximize or at least make
Minimize
the
your taxes.
outcomes, minimize the taxation. And what I was going to say is maximize the favorable outcome. So by
Yeah.
minimizing taxation.
And something as simple as dividing a stock sale between the end of December and the beginning of January could make an enormous difference to your taxes. So you're right, talk to Jose.
Planning. Thank you. For the audience, I want folks to know, and also for our panelists, that, I was grateful, Laura, you mentioned folks thinking about retirement and planning for retirement, and the Wall Street Journal did a terrific piece on planning for retirement. I know a lot of folks, given this past year and a half, are taking just a deeper look at their lives and short and medium and long-term plans in terms of work and retirement and families and all of this. So I'm glad you touched on these topics. Planning should be a lifelong process, starting when you're young and all through. On September 23rd, we will have a discussion with Mark and Jody Rollins of Retirement Transformed about new ways of looking at retirement, what retirement can be. It's not our grandparents' or parents' retirement goals and plans anymore. The work that they do assumes financial planning has been done, and it's more about that stage in your life. So please mark your calendars, everybody, for September 23rd for another stimulating conversation about how we live and our finances and our values and our community. So thank you to everybody for joining us. Thank you.
Thank you.
To Laura and Jose for a very stimulating conversation, which was really understandable. and that's really helpful because we want to understand what's going on and be on top of it and following these conversations at both the state and federal level. And don't forget to read Laura's wonderful column in the Wall Street Journal. So thank you very much.
I always do.
Thank you.
Bye-bye.
Take care.